Ilan Awerbuch with Unitrust Realty Capital. We're also based in San Diego. We provide lending, investments, and opportunities in commercial and residential real estate. We operate primarily on the West Coast, but we've been making forays into the Midwest and in parts of the East Coast also. You've all heard the adage, I believe, that a rising tide lifts all boats. Perhaps you've also heard the converse, that may also be true. And if you've been to Alaska or some other northern climates, you know that when the tide goes out, there's no water in the rivers. And any boat that's anchored there is going to hit the bottom. So what we're looking to do is see how we can kind of smooth out the ups and downs, avoid some of these boom or bust cycles, and thrive through different economic conditions. We'd like to see if we can find models that function as they were designed. One way to do that is to go a little bit beyond the numbers and interpret the quantitative analysis through your experience and the real estate environment. Some of you have read the book Blink by Malcolm Gladwell, and you know it's important to sometimes step back and analyze the numbers through your own common sense and intuition. That will help everyone balance the alpha promises of market-beating returns with the beta reality of the volatility you may need to live through to achieve those kinds of returns. When I speak about deleveraging, basically it's the value of borrower equity in real estate lending. Traditionally, there was a three-legged stool in real estate underwriting: credit quality, income and debt serviceability, collateral, and the resultant equity. The subprime crisis that took place and also had its equivalent in the commercial market resulted from a lot of underwriting standards being loosened in the first three categories. The one factor that was most important that was pretty much disregarded is equity. We see that in the residential subprime world, where borrowers who have problems in those first three categories are given loans even though they have no equity. In the commercial space, we have mezzanine lenders who are going to 90% of the capital stack on acquisition and development pieces at LIBOR plus 300. So if we're going to take risk, we have to be rewarded commensurately with that. Lending at low loan-to-values results in a high degree of borrower motivation and payment certainty. We've seen that in the present market. A-paper borrowers who had all the great credentials have basically given up their properties because they have no equity. They walked away, they've turned in their keys, or they've executed a buy and bail strategy where they bought a new home and let the old one go because it's underwater. Excuse my slides are, I lost the slide. Anyway, the number one determinant of a borrower's willingness to repay debt is their equity, and that is true of all commercial and residential real estate. Some commercial examples that are very high profile are a very large apartment complex in Manhattan, Stuyvesant Town, or a trophy group of downtown high-rise office buildings in Los Angeles. The owners turned those in because they had no equity, and a larger equity position would have probably resulted in their keeping those properties or at least fighting to keep them. Here we have a basic risk-reward paradigm by loan-to-value. As the loan-to-value climbs up on the left, you need to get a commensurate return along the bottom, so your yield needs to go up. You just need to be compensated for any additional risk you're taking. This is part of a basic risk-based pricing analysis. Here we have another way of looking at the risk-reward paradigm, and that's by deal type. On the left, we have what we call standard deals. The note rate is typically 9 to 12%, and you've got a very deleveraged situation, a low loan-to-value, maybe 50% or less, but no higher than 65% under any circumstances. Here we have strong sponsors, we have proven debt serviceability, and importantly, we have marketable properties. As we move over on the chart, the next bucket, you need to really get a return approaching 13 to 18% because you're doing asset repositioning here. You've got a higher risk reward, but you need to make sure that you're being compensated. Perhaps higher loan to values, loan to costs, weaker sponsors, but some form of asset repositioning is going on here, and you need to have a commensurate return. On the right-hand side, we have deals that are starting to get out of the box. More or less, you're replacing equity with debt. Perhaps there's a clouded exit strategy, the sponsors may be somewhat illiquid, or you're providing mezzanine debt. But in any case, in this bucket, we're talking about speculative situations, and return needs to be in that 19 to 30% bracket. Whatever aspect of real estate you're involved in, whether we are doing the lending or you're doing investing as an equity partner, the due diligence is just critical, and all these factors need to be addressed. It's the things that you don't know that usually come back are the ones that haunt you or hurt you. So we strongly suggest that whatever it is, you do the due diligence or have managers who can do that for you in all these different aspects. So here are some takeaways about deleveraged real estate lending. You always have two borrowers, the sponsor signing the note and the property itself. Typically, you've got a predetermined yield that's set by the note rate. Not really speculative, it's not dependent on an unpredictable event. Because of that, it's fairly shock resistant and can produce strong, consistent results for your portfolio. Thank you.